Welcome back. As we wind down the second quarter earnings, Nuvama Group has come out with its earnings review. The report says that though the top line was strong for the companies, the cash flows have remained weak. Prateek Parekh, the equity strategist at Nuvama Group, is here with us on the show now. Prateek, that is the first question, right? Your analysis of BSE 500's private sector's operating cash flow growth has slipped into contraction in the first half of this year, H1FY23, a historic low. Just provide some more data around this and what the implications are.
First of all, thanks, Rima, for having me over. Clearly, I think if you look at the cash flows, right? I mean, there's an old adage which says that top line is vanity, bottom line is sanity, and cash flows are reality. So in some sense, that holds very true in the current context. For example, in H1 so far, we have had very strong top line growth of 25% plus. The earnings growth has been a bit more moderate in single digits, but I think cash flows is where which has been seen maximum weakening. Now, if I look at the weakening of cash flows, it's happening owing to deterioration in working capital, where we have seen an increase in receivables and also inventories of sorts per se. What this essentially means is two things. One is going ahead, you could see some moderation in demand because you've had very good receivables and inventory buildup. And second, and more importantly, if cash flows are going to remain weak, I think it will weigh on private sector sentiments, and their willingness to do capex will be undermined, especially in a scenario where interest rates are rising per se, Rima. So to that extent, I think going ahead, it does not augur very well from a demand or a capex standpoint per se, the current situation.
In your note, you also say that you're overweight on cash-rich defensives, which benefit from commodity disinflation. Can you just elaborate on that? What kind of stocks are you looking at?
Yeah. So if you look at the current environment, right, we are entering an environment in which, Fed has been tightening, and as a result, liquidity is still very tight globally. But the impact of Fed tightening that we have had in 2022 is now showing up. We have had global growth decelerating very sharply, and commodities, which were inflating very sharply for over the last 2 years, are now decisively in disinflation. In this scenario, I think overall growth, the nominal variables will slow down very meaningfully. But the sectors I think that will benefit are those where demand resilience is reasonably high, and also which will benefit from input prices falling. The sectors that typically fall in this category are, something like FMCG, where I think, which had a very big pain point on the margins front, I think should benefit from going ahead from here on. Similarly, something like cement, where demand for cement in India is relatively less cyclical given its high rural exposure. They too will benefit from commodity disinflation, and something like two-wheelers as well is what we like, where we think that the demand has been very weak, a recovery has been very weak post-COVID. So low base accompanied with falling steel prices should boost earnings of these sectors per se, Sonia. So we are essentially overweight consumer companies which have very high demand resilience, and also which have had significant margin pressures in the last 2 years owing to high commodity prices. There, I think the tide will be exact opposite over the next 12 months per se.
Prateek, I remember chatting with you on this show about a month and a half back, and that was when you had downgraded banks, your assessment. But since then, the banks have actually moved from strength to strength. We've only seen banks outperform, and the consensus view seems to be that the balance sheet of the banks is the best that we've seen in a decade. The return ratios are strong. Lending has picked up across the board. And this is kind of a rising tide, which is going to lift the entire banking sector. Would you stick with your view? What has been, the data points that you've picked up in the last month and a half since the time you wrote that report? Because we've had the earnings picture as well from the banks.
Yeah. Again, great question, Rima, for that. So clearly, now with the benefit of hindsight, it suggests that we were early in our downgrade of financials. But I think if you look at this quarter, right, I mean, this has been a picture perfect quarter for banks. We have had decadal high ROAs, and all parameters have fired. You have had margins accelerate to a decadal high. Credit growth again has been very strong, and asset quality very benign. My worry is that going ahead, this picture perfect may not remain so for very long. Since our downgrade, the data points that have come out on the growth front on the economy, whether we look at some high frequency data like exports, or whether we look at the non-oil, non-gold imports, which reflects your domestic demand, consumption, so on and so forth, have slowed materially. The second factor that has come out, since our downgrade is on the prices or WPI front. Now, mind you, a high WPI is very good for banks because it increases your working capital requirements and as a result, your loan growth. WPI growth for manufacturing, which was at 8-10% a year back, has slowed very sharply to around 3-4% now. And given the dynamics and given what's happening to global WPIs, it is likely that this will go down further lower from here on. So to that extent, since our downgrade, while banks have rallied, if I look at the high frequency data, our conviction on the same, has only increased. And to that extent, we maintain that while currently banks are enjoying a very good ride on both margins, growth, as well as asset quality, going ahead, while bank balance sheet will remain strong and asset quality will not be a concern, but I think the consensus exuberance on margins remaining high for longer and credit growth sustaining for a very long time, I think that is at risk. You could see both margins as well as credit growth moderating over the next 3-4 quarters per se, Rima.
Okay, thanks a lot for joining in. It was a pleasure speaking with you, but we need to take a short commercial break. A quick programming note to fully